Well, hello and welcome to One-to-One Mining Investment Online APAC. Today we are going to be talking about mine finance and the ability of miners to raise capital for their projects during the COVID-19 crisis. We've got a fantastic panel for you today. We have Kevin McElligott, who is the Managing Director, Australia for Franco-Nevada, based down in Perth. We have Stephen Motteram, who is the Global Head of Asset Development at Noble Group. We have Jorge Ramiro Monroy, who is Managing Director of Emerging Markets Capital based in Hong Kong. And we have Bert, who is Managing Director and Partner at Denham Capital, also based down in Perth. Gentlemen, thank you very much for joining us today. We're going to be talking, as I said, about the ability of miners to raise money for their projects. So I'd like to start off by looking at the equity capital markets and how they're performing and the availability on the public markets for raising money. Stephen, if we could start with you. The ASX, I believe, there's been quite a few raisings recently. Do you want to tell us a little bit about your experience of those?
Yeah, surely. So the ASX has definitely remained open for juniors, particularly in the copper and gold sectors. That's what our experience has been. To some extent, this has limited some of the distress. It's given them liquidity to continue with exploration programs. Company I'm involved with, Xanadu Mines, we raised money in January before the crisis, and then actually this week as well at a similar price. So the initial raising brought in a new investor. The recent raising was actually predominantly existing investors following their money at what I presume they think are pretty good valuations. The stock's price is obviously down as the copper price has been down, but rallied recently. So, yeah, I think at these valuations, there's still appetite there. Obviously, our raising was quite small. I mean, if you look at Bellevue Gold, Red 5 in particular, there's been some much larger raisings. So it's certainly not the case that the door's shut. And I think the ASX has changed some of their rules, particularly listing rule 7.1. To allow an additional 10% above the usual 15% raising. So that's all helped. Perhaps the other panel members have some comments.
Mm-hmm. Are we seeing a clear difference between, say, a gold company or a company with another commodity, their ability to raise finance? You mentioned some of the gold companies there having a lot of success.
Yeah, I mean, I wouldn't want to be I think on the bulk commodity side, less so iron ore, but particularly the coal side, I wouldn't want to be trying to raise too much money at this point for various reasons, not just the market, but obviously some of the institutional investor appetite there is a bit strained.
That's not really anything to do with COVID though anymore, is it? Really?
No.
Yeah, but you say that, I mean, obviously Xanadu, a copper company mainly, people are still seeing the long-term outlook for copper as decent despite the recent pullbacks in the price.
Yeah, I mean, it pulled back, but I think the last couple of weeks it's had a fair rally as well. If you look at the mid-tier guys, people like Oz Minerals, they went from over $9 to almost to $6, and now they're back up around $9.50. So, end to end between February and where we are now, that's a hell of a range, but it's almost as though nothing happened. Right?
Mm-hmm. Jorge, what's your thoughts on this topic?
Yeah, so from our perspective, we're more involved in the junior side of the market, and it's definitely and we're more involved in gold and silver, of course. And I think for precious metals, there's been a dramatic shift in sentiment, and I think in the Toronto Stock Exchange for junior mining companies, there was I think a record number of financings. I don't know if for the year or even for a number of years. I think a lot of very high profiles in the developers. I think you saw Eric Sprott coming in for 60 million into Max Silver. I think Silvercrest, which is also a development silver story, but a little further behind than Max Silver in terms of when they're getting to production. I think they raised 75 million. So, and then you're seeing everyday junior mining companies with exploration projects with no resource that finally are able to raise, $2-3 million. You're starting to see the prices, the share price go up as well, which hadn't happened in a while. So certainly the sentiment, I would say, in the past 2-3 weeks has improved dramatically.
Is it because investors are seeing bargains or feel that there are bargains to be had?
I think it's more a function of where people are seeing the potential for gold and silver to really continue the rally up. I think the speculative capital the venture capital that's really supporting these companies and these shares. It's just looking at the amount of QE that's taking place around the world, at the prospects for economic development being not particularly great, not just in the U.S. but around the world. And I think investors are positioning themselves for what it could potentially be a continuing rally for gold and silver. I think that's in my opinion the biggest driver. If you look at what you're mentioning in terms of bargain prices, I really think that everything is still quite undervalued. If you look, even something like the GDX, that's the index that holds all the major gold producers. It's still it's at a maybe 5 or maybe even 10-year high. It's still cheaper than it was the last time that gold was at this price. And in the meantime, companies have changed their profile, so they're more focused on profitability. So I think when and I also don't think, by and large, the generalist capital has entered the sector. So I think what's going to happen in the next few months, if gold prices continue to be strong, you'll start seeing the news of dividends. You'll start seeing in the news positive earnings reports for all the miners. And I think people realize that if the senior and mid-tier producers take off, that money eventually will trickle down to the junior market. And I think through that recognition is that you're seeing all this renewed appetite for investing.
Is there a gold price that you think will trigger generalist investors to
I think we're already there. I think it's more a function of, I think the general market doesn't recognize because the press releases have not come out, right? So I think when the last quarter is not necessarily going to be so spectacular, because a lot of mining operations had to shut down. So while gold prices were strong, the production, so some companies are not going to, the news might not be so good. But let's say if this gold price sustains for a few more quarters, if you think about how many companies in other sectors are going to be posting, increase in margins or dividends, all of a sudden, even if the individual fund managers don't want to get into the sector because it's difficult to, sort of an exotic sector for generalists. I think a lot of the quantitative trading and the ETFs, those guys just scan for the headlines, and then I think that will draw a lot of money to our sector.
Kevin, obviously Franco-Nevada, you have a lot of companies under your sort of umbrella. How are they coping at the moment in terms of keeping their operations running?
Yeah, well, like you said, it's spotty. Obviously, the big one is Cobre Panama in Panama itself has shut down for a period. They had a couple of cases of coronavirus, so they're working on restarting and re-ramping up the mine. A couple of other ones have had minor shutdowns. I think overall, maybe we've seen a roughly 10% drop across, if you take the total portfolio in terms of production, just as a rough estimate. It's a bit early. The main thing is that all the companies just withdrew their guidance for the years, for the coming year. So suddenly we have to withdraw our guidance, and there's a knock-on effect there, and it just adds the level of uncertainty to anybody who's trying to make predictions about what's coming down the pipeline this year. And just following up on some of the comments previously, I know I could go on for an hour. There's so many things we could talk about here. We could talk about the news flow with the travel restrictions and exploration being cut back. So where's the news flow on discoveries to take advantage of a higher gold price, or even on deals? You can talk about being able to get on site and do due diligence, which you just can't do right now. So companies are trying to find workarounds for that with some sort of interim deal pending a follow-up due diligence site visit. Yeah, I don't know. There's and the one comment about the gold price has taken off, which is great. For bad reasons, obviously. Obviously, with the pandemic, the flight to safety, and then these $1 trillion stimulus plans, and God knows where that ends up in a few years. There's not going to be much confidence in currencies long term right now. So yeah, I love to see the gold price go up, but not for those reasons. But and the GDX does look cheap because the big producers should have fat profit margins right now. Historically, what's happened though is they've over the next 6 months is they just revised their mine plans, put lower grade ore through, and the costs go up, and the margin goes back to what it was 6 months ago. They take advantage of the higher price to put in lower quality material. I hope that doesn't happen this time. I hope they just have a nice fat margin for a while, but time will tell. Time will tell.
And are you looking at sort of getting into more projects at the moment, or what's the sort of...
We're certainly trying to. We say this every time. We say we're as busy as we've ever been, and it's certainly true today. We feel like we're being pulled in multiple directions. I think what's happened is at any given point in time, there's a few transactions or under consideration that are sort of moving along slowly. And what happened is those ones brought, with our counterparties that we were involved with there, I guess they got a greater sense of urgency as they felt other doors were closing to them. Suddenly they were a bit more motivated to try and close the deal with us. At the same time, I think we're getting a look in at other projects that maybe we might not normally have access to. So, yeah.
What sort of projects?
Well, right now, a good example is one that we just closed last week with SolGold with their project in Ecuador. So, there's a couple unusual elements to that. One is it's a bit earlier stage than we normally get involved in. So it's an interim deal with $100 million committed up front. And, but, in the hope that longer term we'll get into a larger stream deal on the project when it's developed in a few years. And typically we sit on the sidelines and wait until we're looking at actual construction finance for a stream and trying to get in at the final stage. So, and the other angle on that one, as I mentioned, with the travel restrictions, the inability to get your boots on the ground and do a site visit, there's an interim piece to that transaction which gives them $15 million at closing, with the following balance of the $100 million once we are able to actually get on ground.
Fantastic. Bert, if we could bring you in now, your perspectives from the private equity end of town. What are your feelings on the current situation?
Well, first of all, an overarching comment. This is a period of extreme volatility with lots of unknowns. So, all of a sudden you have a very strong equity market, and, tomorrow is a piece of bad news coming out, like a second wave of the coronavirus, and all the gains are going to be reversed overnight. So I think as a matter of principle, I think there's a situation where nobody can make any credible predictions, in my opinion, what's going to happen next. Just take a look at the public market performance just over the last few weeks, right? Some shares have the same value as they had 3 years ago. There's a lot of stuff out there that valuation-wise makes absolutely no sense. But put all of that aside at the moment, I would say that the situation overall is, first of all, quite a mixed bag, right? You have you have quite a number of development assets whose development is materially delayed because of the COVID-19 situation, right? And delay costs money, right? I mean, when you have a situation where you have an owner's team ready to go and you're eating the fixed costs, the G&A costs of building something, and all of a sudden you have to shut that down, yeah, for whatever, 3-4 months. And so that comes at a significant cost to the business, right? So there is not just in private equity portfolios, but also in listed companies, there has to be a truckload of projects that right here, right now, have to spend significantly more money just to stand still than was originally budgeted for. I mean, it has to be that way, right? I mean, you just have to look at South Africa, Peru, mandatory shutdowns, right? In Indonesia, you can't move people around as you want. We know for a fact because we put the projects there, right? So there, first of all, there have to be many companies out there, irrespective of public or privately owned, that have to spend much more money now to stand still than they previously had to. There were, for sure, a number of also very counterintuitive effects. I mean, you mentioned the metallurgical coal before. I mean, not the price is low, but for quite an extended period of time, the metallurgical coal price rose in the early days of the COVID-19 pandemic, despite demand destruction, because, for example, the mines in the US were shutting down for health and safety reasons because of COVID-19, or the rare earth prices were rising during the first half of the pandemic because the Chinese mines closed down, some of them, because of COVID-19. So it's a very strange situation, and the CRU has just said that copper will be material supply surplus for the next 5 years. So there's not one universally applicable statement that can be made. It's a very mixed bag of things, and that mixed bag can change all the time. Now, coming to the private equity markets in particular, I mean, first of all, there were important structural changes underway in the mining private equity industry well before COVID-19, right? And those structural changes were a pivot away from development and exploration risk, and also a pivot away from taking non-controlling stakes. So the number of firms and the number of firms and the amount of capital in the room in mining private equity that would assume early stage risks is shrinking materially. The number of firms and capital in the room that is willing to do non-controlling stakes is shrinking materially, right? When I say shrinking, I would say over a 3-4 year period, minus 70%, something like that. The strategies that most private equity capital providers today are contemplating is either investing into or buying producing assets, or providing structured financing solutions via preferred equity and other, like for example, the typical debt fund structures. So these are the two mainstream private equity products, so to say, in the market today. What COVID-19 has done to this shift that was already underway was it somewhat accelerated it, yeah, because we, for example, we are really focused on producing assets now for the remainder of our capital. And I know as a fact that's the case for like 90% of the other private equity players out there in the market, right? So there's been a strategy shift in response to that crisis. And we are working at the moment on 6 deals that involve producing assets. So, and those 6 deals materially oversubscribe the remaining capital that we have, that we have in the fund. And I suspect you would have a similar situation with the other private equity firms out there. So I would say accelerated strategy shift towards a more de-risked capital deployment. I think that's one result of COVID-19. But at the same time, a higher uncertainty whether you'll be able to close the deals, because at some stage you got to look under the hood with a technical due diligence team, right? So the next question is, when can you get people on a plane to actually carry out proper technical due diligence? You know, because a deal where we invest, or any other fund, $100-200 million US, you got to carry out technical due diligence. I mean, you can't do that just believing what people tell you, because 90% of what people tell you turns out wrong in hindsight. turns out to be incorrect in hindsight. So so that then comes, if this is a deal in Australia or Canada, in those jurisdictions, you'll have a large enough body of technical expertise that you can mobilize locally to carry out the due diligence on your behalf. If it's in a more difficult country where you have to fly people in, it might be more difficult, right? So there's somewhat increased uncertainty how you'll actually able to close a deal with technical due diligence execution, with logistical challenges. I think that's one other consequence of COVID-19. Ongoing fundraisers, so those private equity firms who are in the market today raising capital, it will take them longer to raise that money for two reasons. A, when you raise a private equity fund, you typically have to have 3 or 4 meetings with every single LP before you know whether you get the money or not. But when you can't have the meetings, now a lot of the stuff is happening over Zoom, but not everybody feels comfortable writing big checks just based on a number of Zoom conversations. Yeah, quite a number of US investors also have their own concerns in their portfolio, and that's primarily caused by the demise of oil and gas private equity. Usually, those US investors who support metals and mining private equity firms with capital are exactly the same investors who actually provides the US oil and gas private equity space with capital. And the oil and gas private equity space has been slaughtered essentially. I mean, a few weeks ago, oil was negatively priced, right? So there must be billions and billions and billions of US dollars of portfolio losses washing through the system, eliminating and annihilating a lot of liquidity that's out there. And that eventually would have a trickle-down effect to metals and mining private equity, where the funds which are in the process of getting raised are either ending up smaller or it's going to take a longer to raise them. The exit side, I would say today is not the right point in time to really try to exit if you own a company, because in most cases you're not going to get a lot of value for it. So that's also going to delay future fundraisings. Now, on the positive side, we are having the best opportunity set that we have seen in 3 years. I mean, we were the mining industry, the entrepreneurial mining sector was already living under a paradigm of extreme capital scarcity, I would say, for the last 3 to 4 years, right? And, in between the many who can't raise capital, there's always 1 or 2 darlings of the market that can raise capital, right? But by and large, the industry already got used to having a hard time actually finding capital, right? And so therefore, I mean, we took the position. I mean, we didn't do any deals essentially over the last 1.5 years. And the reason, because we chose to kind of sit and wait, because we took a view that capital starvation is here to stay, and that therefore the opportunity set is going to change, right? I mean, that was the right decision. It would have been the right decision even without COVID-19. But without COVID-19, of course, it means we got a lot of dry powder, which is a good position to be in. So we have certainly seen a very significant shift in the opportunity set, where we think there's a number of deals that we can do on producing assets at returns that significantly exceed at which we could have done deals on development assets just a year ago. That's how the situation presents itself to us today. But again, this is a very preliminary statement, because in some of the deals that we're working on right now, I'm not sure how we will be able to bring them over the finish line, because of logistical reasons with technical due diligence.
Mm-hmm. Is any other panelists finding this due diligence being a key issue at the moment? I mean, Bert mentioned that he has lots of dry powder, lots of deals potentially on the table, but it's quite hard to do the due diligence.
Absolutely.
Yeah, I mean, is that going to create a situation where maybe deals, for example, in Canada and Australia, where you've got lots of local expertise who can do the due diligence for you, might go ahead, but as Bert mentioned, in other more remote locations, it's going to be a lot harder.
Yeah, I think that's a really good point. It's sorry, go ahead.
No, good.
No,
I'm glad.
this is free floating discussion. Just go for it.
No, I mean,
Absolutely.
I'll just say very quickly in my experience that, that, for instance, Canada has less restrictive measures in terms of moving around and access to places, but you cannot fly from overseas right now. You can only fly to Canada if you're a permanent resident. So I have seen, and even for our own work, depending on just local people who are already there and can move close by. Same in countries in Latin America, where typically you would fly a team of geologists and management from Canada to, let's say, Mexico, and given that that's not and in some cases it's actually possible, but people don't want to do it because they don't want to take the risk. A lot of the mining executives are in that sort of high risk age group. So whether for internal policies or just by way of not wanting to run the risk, a lot of people don't want to do it. It's also, for many routes, becoming incredibly expensive to fly and incredibly inconvenient, because sometimes they require you to have 2-week quarantine on either one or two legs of the trip. So I do see that, if that were to continue for many months, I think it would become a significant problem.
How good does the deal have to be before you put up with 2 weeks of quarantine?
If it's only 2 weeks, I had a technical guy involved who ended up, because of one due diligence visit, 4 weeks in quarantine on different ends of the journey. People will only do that twice. There comes a point where people say, I don't care how good the deal is, I'm not going to do that. Life's too short.
Absolutely. I mean, another point that Bert raised there was the fact that the oil and gas industry has been so decimated recently. And given the amount of capital that has traditionally gone into oil and gas, particularly in the private equity space, are we going to see that money going forward, pivoting into metals and mining? Kevin, I mean, you invest in oil and gas as well. Your investors must be saying, forget the oil and gas, let's focus on the gold.
Yeah, it's tough. It's tough right now. We've always had an oil and gas portfolio, just a bit of background. And the last couple of years, when the oil price, when it was at a record price of $100 a barrel, we weren't investing. But when it fell back to $50, $60 a barrel, we started investing. So for the last 2 years, 2.5 years, we probably invested close to $2 billion in oil and gas royalties, thinking, hey, we're buying at the bottom of the cycle. And of course, what's happened recently is that $50, $60 oil price has turned into a $20, $30 oil price. Well, who knows where it's going to settle? And we just wrote off something like 270 million in our first quarter, largely on stuff that we bought not that long ago. So it's tough to see right now. You think, well, geez, if you like the assets that when it was $60 a barrel, you're obviously $30 a barrel is a much better time to buy in. You certainly got to be at the bottom then. The problem is right now it's too soon. Asset values haven't collapsed. There hasn't been that sort of clearing, that recognition that this is the price and these are the values. So we'll see if that flows through in the next few months and we start to see the actual assets changing hands. Right now, people are just marking things down. I haven't seen the actual sales. So we'll see. It'll be a tough call for us to throw more money into oil and gas right now. But we'll see how brave we are over the next 6 months.
Obviously, gold and...
Leo, sorry for jumping in, because you asked the question whether investors would basically take the money from oil and gas and redeploy it into metals and mining, right? And I'm just jumping in here because these are conversations that we are having with a number of very large US investors, literally right here, right now, this week. So I would say the answer to your question is longer term, maybe. Shorter term, the opposite is the case, where they're just going to say, forget all of natural resources. Doesn't matter whether it's oil or gas or mining. And the reason is because there are so significant financial gaps potentially to close in oil and gas that people say, look, with what we already have on our plate in oil and gas, we might have to throw another round of multi-billion dollars at the current exposure in order to make sure that what we already own isn't going to be worth zero to save what we have. So therefore, the very last thing on our mind is to just do anything more in natural resources. We just focus on limiting the damage of what we just currently have. So that is the reaction that I see from most US investors. Now, longer term, with oil and gas being a peak industry, ultimately, longer term, I think there will be a redeployment, yeah. But I'm talking about a process that might, at the earliest, commence in 2.5 to 3 years. So right now, it's really damage limitation. And I know for a fact a bunch of large US institutions who, in response to the oil and gas price decline, have entirely eliminated metals and mining from their portfolio and from their investment thinking as well.
That doesn't seem very sensible, though, with the gold price going where it is.
But gold is on, so let's not forget, metals and mining in terms of global asset allocation, yeah, is a tiny bit. All of metals and mining, yeah. We think the tiny little bit for which you already need a magnifying glass on the global asset mix. Entrepreneurial metals and mining, you need a much bigger magnifying glass, right? That's great, but gold is gold and oil and gas is oil and gas. And if people have problems in natural resources, yeah, I'm not saying everybody reacts that way, but I can tell you very significant pools of capital put a hold on all capital deployment in natural resources as a result of the dramatic losses suffered in oil and gas. I know that for a fact.
Are they putting a hold on just investments in general across the board? Are there other sort of sectors that they're turning to?
Well, it depends how the buckets are organized, right? Most metals and mining. So if you let's say you're a large US pension fund called X, right? No names, right? The way how they are typically organized is there's a real asset team, and that real asset team deploys capital into oil and gas private equity, mining private equity, real estate, for example, right? Then you got another group that's the debt bucket. Then you got another group that's the whatever bucket, right? So, and within bucket, you got the different decision-making structures. And mining private equity typically sits in the real estate. And real estate is in problem. Oil and gas is slaughtered. So within the real asset bucket of the large investors, most of the focus is about liquidity management and damage limitation right now. Not much on opportunity seeking. Now,
so outside of gold, do any of you see any other opportunities in other commodities? Stephen, out of the things that Noble invests in, where are you seeing the best opportunity at the moment, apart from precious metals?
Yeah, so I guess if you think about our business as a commodity trader, it's a little different to private equity guys on the panel. You know, obviously we do take majority through minority investments. We have some asset heavy elements of our portfolio, but through the crisis with some of the supply chain disruption, you know, with some of the shutdowns in South Africa in chrome and manganese, for example, you know, that has created financing opportunities, so stockpile financing and things like that. So we've had a lot of approaches from, you know, usual customers of ours whose supply chains have kind of broken down into China. Obviously, they've freed up more recently, but yeah, so there were some good financing opportunities, stockpile financing opportunities, and even outside of South Africa into some of the junior iron ore players in Australia, with iron ore prices having held up the way they have. You know, it brings back the marginal producer, right? So everyone's very focused on what's going on with Rio and FMG in the Pilbara and BHP, and obviously there's supply disruptions in Brazil. But you know, there's a whole sector of smaller iron ore guys who get dragged back into the market with prices at these levels, and often some of them need supply chain financing. So that's been quite interesting. You know, we continue to be a significant coal trader. So, you know, Indonesia is an important market for us. So we continue to operate there. Obviously, the coal markets have been a little more challenged on the demand side, but certainly, I would hope that we've bottomed there. Chinese sort of power generation started to pick up again. So we're seeing a little better demand there on the thermal coal side, but obviously Europe's still pretty challenging. So it's a very patchy market, I think, as Bert was saying before, from a supply chain perspective. Some supply chains have freed up and they're flowing again, and then others are just very patchy. But that creates opportunities for a commodities trader. Yeah.
And obviously this crisis has ramped up to a certain extent the tension between America and China. It certainly hasn't helped solve the trade war. Do you see that having an impact going forward as we come out of the crisis?
Yeah, I just make one comment there in terms of a specific example. I mean, there's not that many distressed sales, I guess, being completed, but we're working on one at the moment in Queensland on the copper side. And yes, in terms of getting people on site to DD, as we've said, within Australia, that's still possible. But when you put the regulatory overlay on top of closing a deal, particularly if you're trying to bring significant foreign funds into deals in Australia, the Foreign Investment Review Board has changed their rules. So they've reduced for countries that don't have a free trade agreement with Australia, they've basically reduced the threshold from about 250 million to zero. And commitment in terms of timelines to turn around decisions by the Australian Treasurer have gone from 1 month to up to 6 months. So there's a regulatory overlay here, and whilst you wouldn't specifically see it written that that's targeted at China, it has an impact on foreign investment coming out of China. And I guess from a regulatory perspective, there's still a concern that from a government perspective that they don't want opportunistic, distressed assets being picked up cheaply in that way. Yeah.
Well, yeah, I wouldn't feel that that's directed at China, because that's directed at everybody. From being a foreigner living in Australia, and we feel that that's something we have to highlight on stuff that we're looking at right now. That hey, this could take 6 months to get approval, which seems ridiculous. But it's all meant to avoid opportunistic, low-value acquisitions. So
there's something really positive. There's really positive here as well. I just say, because I say some jurisdictions in Australia clearly try to make permitting and all this process is much easier right now because they want to kickstart the economy. So let's ensure that in this discussion we don't ignore that aspect as well, because we have over the last few weeks seen had quite a number of positive surprises general in our portfolio, where actually bureaucracy and administration tries actually to be much more helpful and proactive than they have been in the past in terms of getting projects development ready to create jobs.
I mean, that brings up a good way for us to possibly wrap this discussion up, is that, as we come out of this crisis, are we going to see, with governments, pouring money into things, are we going to see a real sort of rebound in the sector, do we think? I mean, what's the long-term impact of this crisis?
No, nobody's brave enough to make a prediction there.
Absolutely. Bert, you must have a thought.
Well, what I can tell is a market analytical study on a commodity that we have just commissioned moved in the last 72 hours from the base case assumption from a V-shaped recovery to a swoosh, almost L-shaped recovery. And the impact, whatever scenario you believe, is tens of billions of dollar magnitude. The truth is, nobody knows. We can all have our opinions. This might be because of a lot of cheap money, might be V-shaped recovery, and all of a sudden, whoosh, there's a vaccine, right? You might find out there will never be a vaccine, like for SARS, right? And you may find out it's huge demand destruction, and you might find out there's a second and a third wave is coming as parts of the world is getting in the winter again, and all gains are being completely eroded. And what looked like a stock market low a few months ago would be the new high. No one knows. I don't even want to speculate. It's just no one knows.
Absolutely. So in conclusion, you know, there have been a lot of capital raisings recently. Miners seem to be still able to find finance for their projects, but it depends on the commodity. It depends on the jurisdiction. Due diligence is obviously a crucial aspect. If people can't do the due diligence, they can't do the deal. And COVID is putting some roadblocks in the way of that. But we just have to wait and see how things play out in the months and years ahead. But thank you very much for all your insights today. That's been very interesting, wide-ranging discussion. And we look forward to seeing you live when this thing is over. But if not, via Zoom down the track. So thank you very much.